Hey everybody, I'm John Van Duser and I'm here with Justina Mueller. We're both partners with James Moore and Company and members of our real estate services team. So we're concluding our video series on how the CARES Act impacted the real estate industry. And so if you haven't already seen our videos, check out our videos on qualified improvement property and the changes to the net operating losses. And right now we're going to discuss the changes to the business interest limitation. So the Tax Cuts and Jobs Act enacted Section 163J, which is a business interest limitation. In general, it's for large companies with gross receipts greater than $25 million. But before you completely tune out, there is one exception for tax shelters, which really hits home in the real estate industry. So Justina, why don't you tell us what a tax shelter is?
And hi everyone. I know it sounds a bit out there when we want to talk about real estate holdings being a tax shelter, but it's not. Most of us think of a tax shelter in a concept of tax evasion, which is one of the definitions of it. But a so-called syndicate is also considered a tax shelter. So syndicate is a partnership that has a loss in the current year, and more than 35% of that loss is allocated to a limited partner in that partnership. So that partner is not a real estate professional. Partner doesn't actively participate in the activity. It's pretty much just like your quiet investor. So if more than 35% of the loss is allocated to that partner, you are dealing with a syndicate, which is considered a tax shelter, and now you need to start looking at those interest limitation provisions of the tax reform.
Right. So if I'm a developer and I have some golfing buddies and I say, hey, let's kick in some money and go buy an office building, I could be teetering on the definition of a tax shelter, and it really would depend on their level of involvement in the venture. Does that sound right?
Yeah, and it's not uncommon. I mean, that actually happens with a lot of our clients where, you know, a main person who knows real estate just pulls some money from people who are not actively involved in real estate. So the whole idea of syndicate and the tax shelter in real estate, it's more common that people think.
Yeah. So to talk about the CARES Act and how that impacted it. So the Tax Cuts and Jobs Act, when they put this piece of this limitation in place, it was basically up to 30% of your net operating income for 5 years. And then after the 5 years, it would be your net operating income minus your depreciation and amortization expense. So that's a real general definition, but you can see where that could have a huge impact, especially if you're highly leveraged. The CARES Act loosened those restrictions a little bit, and so instead of it being 30%, it's now 50% for a period of time. And so that's a really big benefit. And then the other thing that it did for partnerships specifically, which the rules are somewhat convoluted, there's a 30% limitation in 2019, but any interest that was disallowed, you can basically automatically deduct half of that in 2020. So that's a real big benefit to partnerships who may be a tax shelter for tax purposes in their 2020 year. So it's definitely something that you want to take a look at. With all these videos, if you feel like you have qualified improvement property or net operating losses, or you really want to take a look at interest expense and determine whether you're a tax shelter, this is something that we deal with our clients on a daily basis. So visit our website, www.jmco.com, or call your tax advisor and have them give you the information that you need. So thanks guys for tuning in. We really appreciate it.
Thank you.